Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. The FANG index is rolled over, while crude is outperforming expectations. He also takes a look at gold and bonds. Dr. Marc Faber checks in from Thailand, where he examines the Dow, interest rates, bond prices, gold, silver, and the possibility of hyperinflation. He also comments on China's economic activity. Vancouver realtor Steve Saretsky is here to talk about how much the market has changed from a year ago and what might happen with mortgage rates. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMYresources.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to This Week in Money, Ross.
Always good to be back, Jim.
And we're welcoming new listeners and all of our listeners with a special deal.
Yes, well, we usually have a special which is $200 for 2 months, so people get the opportunity to see what the service is like. And that's for first time users who want to come in and just kick the tires a little bit. But for the next 10 days through the 14th of March, we're doing 25% off the annual subscriptions for new subscribers. So, get a chance to either take a short-term look at us for 2 months or take the plunge and be around for a year. And, typically within a year, there might be, half a dozen big opportunities where we get major exhaustions or major capitulations like we had March of last year, or like we're seeing right now in the bond market and the precious metals. And that's, it's those key points, those big turns where the money is made. And, we're into one of those time windows right now where the pieces seem to be fitting into place. And this is where people can get I think, a real bang for their buck.
Talking about some of the big turns, what's going on with tech stocks, the former darlings?
The leader up until last summer, clearly the FANGs, the tech stocks, that FANG index, which has 5 of the names we know, plus another 5 on top of that, of big performers. They rolled over, and we've seen, value really outpace. If you take a look at the Russell 2000 divided by the NASDAQ 100, that's been moving in favor of the Russell Value Group since September. And, even this week, as the markets were having a tough early part of the week, the Russell continuing to outpace on the upside. And, the biggest names, the Teslas, the Apples, have been just under big pressure. And, this rolling that we see here is not unusual, and you're going to see that at any given time, that one sector will be finally undervalued and people will look at moving into it. Just look at what's happened here in the energy market, the most unwelcome sector. And guess what it's doing? It is just outpacing everything right now. You've got oil up at $66. I mean, even the bulls 2 months ago were thinking 60 might be the top end of the run, and here we are another 10% above that. You've got to be looking for the changes as they're happening and, take advantage of them. And, at this point, with the new administration in the U.S. and the talk about new tax legislation possibly coming in, wealth taxes or changes in capital gains, etc. The money that's been made, the big money, most recently in the tech stocks, they could be looking at some hefty tax bills. So, a little bit of concern will cause people to look around and say, well, rather than that, is there another place where there's some value that I can just step into? And clearly, there appear to be other items.
Has Tesla continued to slide downward?
Yeah, this was a pretty rough week here for Tesla. We ended up with the stock down another 3% on Friday. Here you are. You were at a $900 stock or thereabouts just a month and a half ago, and as of Friday, that kissed 550. So down a good 45% off the high. And if we look at it historically, you'll look at the weekly or monthly moving averages and how far this has run. Maybe this is a sub $500 stock by the time this correction is over with. And then you see what happens after that. The other big name up there that a lot of people own is Apple. This was $145 a month ago. We were spent this week under 120, and the real support for Apple looks to be closer to 100, maybe around 103. Wouldn't be a tall surprise that you end up seeing that in the next month or two, because we are at that time of year in the first year of a presidential term after an election, where you tend to have these rolling tops. You end up with a mid-February to early March high, and then you will rode through until late March into April. And the transition we're seeing here looks to be realistic. You take a look at the number of new 52-week highs and new 52-week lows, you got over 2% on a couple of days here this week where you had both of those happening. So this type of divergence within the market says that it's not just a one-way train anymore, and you've got to be looking more for specific stocks or indices rather than the overall market.
What's going on with gold?
Well, really happy with the action that we've seen here. The failure of the precious metals, silver and gold, to move well after November. They had a little bit of an uptick as part of their seasonal play at the end of December and early January, but they couldn't get back anywhere near the August highs as far as gold was concerned. Silver did a test, but was unable to get through, even with the squeeze play that they tried to do on the SLV. And any time that we see that type of divergence, then gold ends up having to go down and take out its last supporting low. So that was at 1767. There's no way that gold was going to hold up and not break down. Our targeting had been under 1700 for this leg down. We did get down to 1690, and there's a lot of pieces that started to fit into place as of this week. We are oversold enough that the capitulation signal that we have that is designed to find these panic lows, that kicked in on Thursday, Friday. The last time we saw it was back third week of March last year, which was a major low. And if you recall, that break was very quick. That took just like a week or week and a half. Most capitulations are like a waterfall, that they take time to develop. They just slowly roll over and then start to go into a vertical mode at the tail end. And that's the design that we've seen here, leading up to this move under 1700. So from the pattern perspective there, we're seeing good capitulation, capable of a bounce. From a timing perspective, the sequential readings that we do on a weekly and a daily basis would suggest that the low should be nicely in place by the time we are at this point next week. Any upside reversal probably has pretty good chance of a decent rally. I would say a tradable rally, but I don't think this will become the lasting bottom. There are pieces that we look at as far as the miner is concerned. They just haven't sold off hard enough right now. And I would think after a decent bounce, we're probably back down retesting or taking out the lows, and maybe a more lasting bottom sometime as we get closer to the summer.
What's going on with bonds?
Bonds been good for us. They broke down in January. A week ago, we advised taking some money off the table. We'd had a dramatic drop with the bonds getting down to the point where interest rates have gone from 0.5% up to 1.5%. And this week they managed to go a little bit further, but they're pretty stretched as far as the bonds are concerned on the downside or interest rates on the upside. So we're going to be looking for a bounce here in bonds, but overall, while sentiment may be exceptionally bearish right now, and we could have a pretty good bounce, I would suspect that should be a saleable bounce. If anything, if you've got mortgages coming up for renewals, you probably want to lock in 5 years or better, and not be open to any of the inflation concerns that may be coming down the pike here.
Ross, thank you so much for chatting with us, and can you remind people again about your special offer?
Once again, $200 will give you a 2-month trial. So we'll show you everything we've done the first part of this month through the end of April, and then there's 25% off for the annual subscriptions for any new subscribers.
Ross, thank you again.
Thank you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at ChartsByRoss. Coming up, Dr. Marc Faber next on This Week in Money.
Always consult your investment professional before making any investment decision.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Dr. Marc Faber, editor and publisher of the Gloom, Boom, and Doom Report online at gloomboomdoom.com. He's speaking to us from beautiful Chiang Mai, Thailand. Marc, welcome back to This Week in Money.
Well, thank you very much. It's my pleasure.
Marc, for people new to the Gloom, Boom, and Doom Report, what's it all about?
Well, it's about highlighting opportunities around the world and taking a contrarian perspective. In other words, you try to find sectors and stocks that are neglected, that nobody wants, but because of that neglected status, they are also inexpensive. And we try to avoid, very popular sectors.
The Dow hit 32,000 points. Where do you think it's going to go from here?
Well, I think they will continue to print money. And as a result of that, in the long run, I suppose that everything will go up. But as we've seen in the last few days, there were some stocks that went up, although the market was weak. And the previously popular stocks, such as the FANG and related stocks, semiconductors and so forth, they've been weakening. So I think that it's not so much a question to say, well, what do you think of the market? Will it go up or down? It's a question of which sectors do you choose within the market.
Are interest rates likely to head higher?
Interest rates have been coming down since 1981, in other words, close to 40 years. And I think, yes, from a longer-term perspective, they're likely to go up. However, the bond market has tumbled over the last 2 weeks, and it has become very oversold. So I think that a rebound in bond prices is overdue and will likely take place when the stock market weakens. In other words, it should kind of bottom out now for a rebound. But long term, of course, I think bonds are toast. In other words, I think they're not a very good investment.
Is money leaving the bond market? And if it is, where is it going?
Well, it's gone into stocks and into, as I said, some sectors are losing momentum and some are gaining. The last, say, 4 weeks, oil stocks have been very strong, and banks. Even in Canada, banks have performed well over the last couple of weeks. But notably, oil stocks have been very strong.
What could interest rates in the bond market mean for the real estate markets going forward?
Well, that is like the stock market. It depends. How much money will they print? I think real estate in the long run is still okay, but there are shifts occurring where some people leave city centers and where offices close down in city centers and people work from home and they go to the countryside where for the same amount of money they can buy a 3 times, 4 times larger property. So I think there is also a shift in real estate investing and in the way people live.
Your thoughts on gold as we head into the spring of 2021?
Well, as you know, we had a huge rally in gold between 1999 and 2011, and then a longer-term correction, 2011 to 2015, December. And then again a strong rally until last summer, again interrupted by a few declines. And since last summer, we've been in a correction. And I think a lot of people have been surprised by how severe the correction was. And we're down from 2000 to around 1700, and some gold and mining stocks, they're down 40-50% from the highs. Not all of them, but some are down close to 50%. So we had a big correction. I think we're moving into a buying range. I think it's quite a good time to increase positions.
At these prices, is gold still a good place to store money?
Yes, I think so, compared to everything else, because everything else is also inflated. The gold price is obviously not as cheap as it was in 1999, but it's not terribly expensive compared to the quantity of money they've been printing. So I think, yes, you should hold some gold. And in fact, as I've always said on your program, you should buy every month a little bit of gold. Don't put all your money into gold. It's not a question to have everything into gold, but it's a question to have some money into gold.
Is this an era where you really should be diversifying and not piling into just one particular asset?
Well, I think we are in an environment which is highly manipulated by central banks and central bankers who are not particularly intelligent. And so there is a big question mark. How will this all end with this money printing? I can't imagine that it will end very well, but, it can take time until there is a huge collapse, and maybe a huge collapse doesn't come, but the collapse occurs against the price of gold, or of silver, or of cryptocurrencies. So there's many ways the way paper money can be destroyed. So we don't know that. But my view is that you should have some money in gold and silver. And platinum, by the way.
Silver seems to be trading in a range. When silver breaks out of this range, is it likely to be up or down?
Well, I think the precious metals, as I said, they've been in a correction phase since last August. So essentially for more than 8 months. I think in a perfect world, they would sell off another $100 or so on gold and maybe $2-3 on silver, and then it would form a very important low. The reason I have some confidence in this forecast is that the ETFs that invest in gold and silver have had large outflows. And these large outflows usually, I'm saying usually, coincide with a bottom in gold and silver.
Does it look like the U.S. dollar could strengthen from here?
Well, I think the contrarian play, but it hasn't really worked out yet, is to be long U.S. Treasuries as a trade, and long the U.S. dollar, and short the FANG and FANG-related stocks.
The Canadian dollar touched 80 cents U.S. Could this be a trend in motion for the Canadian dollar?
Well, the trend for Canadian dollar strength has been in existence for quite some time, at least 6 months. And the Canadian dollar, in my view, has become rather overbought. So that's why I just told you I think the US dollar could rebound. And that would mean that the Canadian dollar goes down against the US dollar.
During a worldwide pandemic lockdown and high unemployment, real estate markets, the stock markets, and auto sales have taken off. Does that make any sense?
Yes, because the weakness in the economy has been offset by money printing, and massive money printing. And so the money printing didn't go into consumption. Some went into consumption, but a lot of it went into savings and into speculation, into bitcoins and GameStop, and all the Robin Hood type of shares. And so we had this huge bull market while the economy was weak.
Are we likely to see the lockdowns ending soon, and what could that mean for the markets?
Well, I think the lockdown ending soon, we have to ask the governments, because in my view it looks like a very artificial type of thing, this COVID-19, and it's interesting in the US. If you look at charts about COVID infections and deaths and so forth, it rose under the Republicans until December 2020, in other words, 2 months ago. And as soon as Biden got elected, the infections went down and the death rate went down, and they began to open up the economy. What a coincidence.
We'll have more with Dr. Marc Faber right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Dr. Marc Faber. Marc, what's the latest on China? What do you think its economy is doing, and the difference between what it really is doing and what the government says it's doing?
Well, it's clear that there has been a slowdown, unquestionably. But the economy, we have to compare things, So if we compare the European economies, the U.S. economy, and the Chinese economy is doing okay. It's not a boom, but it's doing okay.
Does China really rely on the West buying its products to get its economy really humming?
China exports more to emerging economies. And if commodity prices go up, as they've been going up recently, it actually helps China. China exports to the U.S. is only about 2% of GDP. Of total exports, it's maybe 15%. But it's not that the Chinese economy depends on America.
Do you think China's on its way to becoming a superpower and that its goal is to spread communism around the world?
China doesn't have communism. It has a dictatorial government, a single-party government, and as you know, we were all brainwashed going to school how great freedom is in democracies, and now we have to learn that democratically elected government officials can tell people you stay at home. And in some cases, you couldn't even go out and have a cigarette in your own property. You understand? When you have this restrictions on your freedom, you have to ask yourself, well, what's the difference when I live in China and I have an authoritarian government, whereby in China you have a lot of economic freedom. It's just that you can't criticize the government. But in the U.S., have you ever noticed what happens on Google and on Facebook and everywhere where you criticize the government?
You get cut off.
Well, it's a fairy tale that is told by the schools and the teachers and the government that in democracies you're free. This is simply not the case.
Where are the freest places in the world to live right now?
Depends how you define freedom. If you define freedom like going out and, having a smoke and going here and there and so forth, the Asian countries are rather free. Latin American countries are rather free. But they're not free in the sense that you can criticize the government. You can positively criticize, but you have to be careful.
So it really depends on what your personal definition of freedom is.
Correct.
If all the central banks hyperinflate at the same time, are the usual results of hyperinflation muted?
Well, there can be, inflation in commodity prices, in food prices, in asset prices. We had it so far in asset prices, but as you know, the standard of living of young people has gone down because of affordability. Life for young people is very expensive to buy a house, to pay for the insurance premiums and everything. So they can inflate. The inflation that they've created doesn't help the economy much, or actually is detrimental to the economy. And so we have to, again, look carefully at what the measures by monetary and financial authorities are, in other words, by the central banks and the Treasury Department, what the impact is on the real economy. We've discussed that under these conditions, asset prices go up. Maybe not all of them, but some of them.
It sounds kind of dirty, but what are your thoughts on naked shorting and short squeezes?
Well, I don't want to make a recommendation here whether you should sell short or not, because I'm not your personal financial planner, and I don't know your listeners. Mm-hmm. In my opinion, short selling is a very useful tool, and it has the impact that it stabilizes markets. What happened in the case of GameStop was unusual. This doesn't happen every day. And I don't want to go now into all the details why it happened and so forth, because it takes me an hour.
Mm-hmm. What are your thoughts on the Biden administration and massive voter fraud?
I think in a few years people will say, what a disaster this administration was. And I know from actually politicians, there has been voter fraud in the U.S. for a long time. It's not the first time.
Where are you putting your money right now?
As I told you, I own gold and silver. I own gold and mining shares. I own oil shares, and I have some banks. And most of my money is either in emerging economies in Asia, and some is in Europe, in European stocks.
Bitcoin and other cryptocurrencies, are they going to replace fiat currencies?
Maybe. I think eventually paper money will be replaced. Will it be by bitcoins? Who knows? It could be something else. But I think the way we transact with paper money will be obsolete in, say, 5 to 10 years' time.
Do governments want to get rid of paper money because they want you to go digital so they can track and tax everything you do?
They track everything you do already now. They have your mobile phone. If they suspect you of something, they know exactly where you are and what you do already now.
Overall, are you seeing gloom, boom, or doom ahead?
I think, the COVID-19 has made a lot of people much richer than before. The big shareholders, Jeff Bezos, Bill Gates, and so forth, they all became richer during COVID-19. At the same time, a lot of people have been impoverished. They had saved and opened a business, a coffee shop or a hair salon or a tattoo shop or whatnot. A lot of these people, they've lost everything. It's a tragedy. That's why I say this COVID-19 is something fishy about it, to put it mildly.
Nevada is proposing that companies be allowed to form their own municipalities, their own government, their own police forces. Is this a slippery slope?
Yes, I think this has to be encouraged. But don't think that the central government, in America, the federal government, will allow them to be totally free.
What about personal rights and freedoms if it truly is a company town where they control everything?
Well, you have some freedom. You can buy your property. You can live in your property. But, maybe it will change.
How can people find out more?
You cannot express your views anymore. If they take away the freedom of speech, the next thing will follow soon. We don't know yet exactly what it is. But I'm just saying that we're not as free as we were told we were when we went to school.
Were we ever really free?
Look, it takes me 3 hours to talk about the subject of freedom because this is a philosophical question that depends on your own attitude. You can be very free if you accept that you should be happy with what you are and what you have. So if you say, oh, I live in a very small house, you can say, yeah, but I'm free. I like it this way. I have no debt. It's very small, yeah. But I like the freedom and so forth. So everybody has a different freedom. People who are married, they're not entirely free. It's obvious.
How can people find out more about the Gloom, Boom, and Doom report?
Well, they can go to the website gloomboomdoom.com, and there are different ways to subscribe to it.
Marc, thank you so much for being on This Week in Money.
Well, thank you very much for having me on your program. I'm sorry I can't answer your question about happiness and freedom. Maybe you have to ask a priest or a guru in India or a philosopher.
I've always been told you make your own happiness. Don't rely on others to do it for you.
Largely.
Yeah.
Not only, but largely.
Marc, thank you again.
Thank you so much. Bye-bye.
My guest has been Dr. Marc Faber, editor and publisher of the Gloom, Boom, and Doom report online at gloomboomdoom.com. He was speaking to us from Chiang Mai, Thailand. Coming up, Steve Saretsky, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Steve Saretsky. He's a Vancouver-based realtor, online at SteveSaretsky.com, on Twitter at Steve Saretsky. Welcome back to This Week in Money, Steve.
Yeah, thanks a lot for having me on.
Steve, is the March 2021 edition of the Saretsky Report out yet? What's in it, and where can people read it?
Yeah, no, we should be, I think by the time this thing publishes, hopefully should be out in the next couple days here, but you can just go to stevesaretsky.com and sign up, and we always keep it free once a month, so it's kind of your in-depth report on the Vancouver/Canadian housing markets.
How are February sales and price figures looking for housing from the low end to the high end?
Yeah, we had sales, Greater Vancouver sales up 74%. Year over year. And, it was the second strongest February that we've ever seen on record, other than February 2016. Of course, if anybody remembers February 2016, that was arguably, you can pinpoint it, I would probably say the top of the housing market, before we started to slow down and, turnover, back then. So, that was kind of the height of the foreign buyers, coming in, et cetera, bidding wars. So, yeah, we're kind of getting close to those levels, and it's very surprising, obviously, given the lack of foreign investment this time around, the lack of population or immigration coming into the country. Really not a whole lot of fundamentals driving this, just purely liquidity.
Are lower mainland real estate prices higher now than they were at the top of the market in 2016?
Yes, they are. I mean, it depends on obviously what you're looking at. I mean, if you're measuring strictly luxury house prices that are, $4 million plus, I would argue that market is probably still a little bit off from the 2016 highs. But if you're looking at the general market where, the average person is purchasing, condos, single family homes for your, typical family, right? So, houses that, under $2 million, for example, houses in the suburbs, those are all hitting new highs. And so, I would say for the most part, in general, the market is higher today than it was in 2016.
Are a number of home sellers waiting for COVID to go away before listing their properties?
Yeah, it's a good question. We actually don't have a problem with, new listings, actually. When you look at new listings across Greater Vancouver, they're actually up 25% year over year. So new listings are coming in just fine. Same for, if you look at the single family housing market, which is where you're seeing the majority of the strength and the bidding wars and the froth. I mean, new listings are up 33% year over year. So you have people coming onto the market and listing their houses for sale. It's not really a situation where people are saying, oh my gosh, I'm scared of COVID, don't want to list my house, don't want anybody coming through. That's not the situation. The situation is you basically just have demand overwhelming the supply that's coming to market. And so, if you're looking for a single family house, in Greater Vancouver under $2 million, which is where most locals are actually looking and competing, you have 1.5 months of supply for sale. So it's an incredibly tight market.
When the economy opens up, do you think prices in the suburbs and small towns will continue to appreciate?
Yeah, I think that's a tough one to answer right now. I think that a lot of this really hinges on how companies are going to react with, work from home measures. Are we going to be going to more of a hybrid model? I suspect, but I think a lot of people will still go back to the office. So, in my opinion, I think that the recent move in the suburbs is overplayed. I think that you'll see a pullback. I think that a lot of people will want to get back into, working and socializing at the office. And I think the downtown core in particular will have a resurgence or revibrance that will come back, and I think that market will recover quite a bit.
A couple of Canadian banks have warned about the possibility of increasing mortgage rates, which could have an adverse effect on real estate. Are mortgage rates and the bond market the elephant in the room?
Yeah, I mean, I think that what we've seen obviously over the last couple of weeks, I mean, we've seen yields backing up. You have 5-year fixed mortgage rates as a result are pushing higher. So you've got, we've probably gone from about 1.5, 1.6% on your 5-year fixed mortgage to today most banks are now looking at about 2%. So, you've seen a 30, 40 basis point move in a 5-year fixed mortgage. I mean, obviously you're still borrowing at 2%. Hey, can that go up to 2.5%? Yes, for sure it can. I think at some point, obviously the central banks globally are watching what's happening with yields backing up, and I think that my suspicion is they'll let them ride here for a little bit before ultimately the pain becomes too much and they have to step in with some shape or form of yield curve control, which they've talked about. I think we had the ECB out this past week, saying, they're watching yields. Obviously, Powell was out this past week as well, making some commentary that, we're just going to let it ride for now. So I think for now, but obviously, hey, don't get me wrong, if we have, in Canada, if we have a 5-year fixed mortgage that jumps from 1.5% to 3%, you're going to see an instant slowdown in the housing market.
How long does it take for higher mortgage rates to show up in the pricing of properties?
Well, I think a lot of it is psychological too, right? When people start to see mortgage rates creeping up, they go, well, hold on a minute. This is going to start to, they start to go, well, so we had back in 2018, we had, the 5-year mortgage was up at around 3.5%, and everybody thought it was going to go to 4%. And we saw the markets really start to slow down. It was a soft housing market. Prices were coming off, and of course, then we saw yields obviously start to drop from that 3.5 mark, and that was kind of what kickstarted the housing market back up. So I think a lot of it becomes psychological, where people look at the markets and say, well, hey, if it's 3%, and they start calculating their monthly payment, they go, well, I'm not going to get into a bidding war and pay $100,000 over ask, if my mortgage rate's 3% and if I have to renew in 5 years and it's 5%, it starts to make people think twice. So again, I'm not bullish on higher rates. I think that they're ultimately, they're going to run higher here in the near term, but I think that they're going to get quashed, by these, central banks.
Do people look at the overall price tag when they buy a home, or just how much am I going to be paying a month?
Yeah, I think a lot of it just comes down to debt servicing. I think most people are just looking at the overall monthly payments. And, obviously when you're borrowing at, say, 1.5%, it's certainly much more palpable than borrowing at 2.5%. So, when you have a highly levered asset, like, particularly Vancouver real estate, where people are taking on, $1 million mortgages, the interest rate matters quite a bit. So, it's certainly something to keep an eye on.
What are people in the lending business saying about mortgage rates?
Not a whole lot. Obviously, they're just, they're going up, and something to be cognizant of. I mean, the variables are unchanged, right? So that more reflects off of the Bank of Canada's overnight interest rate policy. But, what's happening in the bond market is certainly worth watching. And like I said, I think in the near term here, you'll probably continue to see yields push higher as inflation expectations rise. But, like I said, I think in the longer term, I think everybody is well aware that the entire global financial system cannot withstand higher interest rates. And so there's going to have to be some sort of policy intervention. And whether or not they're successful with that policy intervention, remains to be seen, but I think it's obviously inevitable. We've already have a lot of central banks doing some form of yield curve control. I think one in particular to watch is the RBA, the Australian Central Bank, which also has a highly levered housing market. They've been very active in their yield curve control and most recently ramped up their purchasing to quash the recent rise in yields. So, and again, I think it's something worth watching. I'm not saying that they're going to be entirely successful, but if you think that they're just going to let yields rise and not do anything, I think it's kind of misguided.
Do you help your clients find the best mortgage rate?
Do I help my clients do that?
Yeah.
Well, I mean, I always have a pulse on what the mortgage rates are, so I'll just kind of, I think it's more important is having a good broker on your side as opposed to just, negotiating over, say, 5 basis points. A lot of the times it comes down to, well, what's the prepayment penalty? What kind of service are you getting? So there's a lot of variables that go into it that's strictly just like the best rate. But, yeah, certainly I always try to have a pulse on the mortgage market, and gives me more intel to advise my clients.
Did people save money because they had deferred mortgages and then use that money to purchase a new property?
Yeah, I'm seeing some of that. I'm seeing some of it, like, anecdotally, of like, hey, Mike, when we're putting offers on houses or people putting offers on my listings, it's, you get a cover note that says, hey, my clients, had a wedding plan, they canceled it due to COVID, so they've saved up some additional money, so they'd like to buy your house. And, that's kind of what we're seeing. And if you look at, the data kind of says it all as well. I mean, we've got, a household savings rate right now hovering above 25%. That's the highest I think we've seen, ever. And, so, there's a lot, people are sitting on a lot of savings, obviously, when you're not going out. There's not a whole lot to do. You're saving money at home. So, that's certainly something to watch, as the pandemic, eases and we kind of reopen.
Can central banks continue to print money without any checks and balances?
Well, I mean, I think there's always repercussions. I think the repercussions are, look what's happening to the housing market. You have zero fundamentals to argue why house prices are up, 15% on a nationwide basis. And I suspect that number could hit 20% by, this summer. And so, I think that's the repercussion. It's like, you can't just print your way to prosperity. There's going to be repercussions for that. And I think the repercussions are going to be societal, in terms of you're going to have a larger and larger wealth inequality. And I think you're going to see more and more, sort of populist movement, just because people are upset. People feel like they're getting left behind. The social contract, I think, is failing. And I think that these are all repercussions of these easy, money printing policies, is that, people's wages simply aren't keeping up with the cost of living. And I understand that, CPI, quote unquote, inflation metrics, I don't think are an accurate reflection of the real cost of people's, day-to-day living.
Yes, well, I think back in the 90s they removed fuel and housing from the official inflation index. Well, those are two of the most expensive things you face.
Right, yeah, and I think, you look around today and say, well, the Bank of Canada says CPI inflation is just below 2% today, and, we're failing to hit our target, so we need to keep interest rates low until 2023, and it's like, well, that may be true, but I think, again, if you ask most people, particularly people that are trying to enter into the housing market, I prefer to, it depends on your unit of account. I mean, I think, like, if you're measuring your wealth or your net worth based on if it's keeping up with inflation at 2%, I think it's a failed metric. I think that you should be looking at, arguably other things like, you could be looking at M2, which is your money supply. I mean, money supply growth is up 15-20%. So I think that's probably a better unit of account, unless your assets or your net worth is growing by 15%. You're probably not really keeping up with the true cost of, at least asset inflation.
Could the Bank of Canada keep the official bank rate low while the mortgage markets have a mind of their own?
Yeah, I think so. I think that, again, yields are going to do what they're going to do here in the near term, but I don't think that's going to suddenly stoke the Bank of Canada or the Fed. I mean, the Bank of Canada basically follows the Fed, so I don't think that's suddenly going to stoke the Fed to all of a sudden hike interest rates. I think that they've painted themselves into a corner, and I think we're going to be, lower for longer is my view, and I do think we're going to see some inflation, and it's going to be, something they're going to have to try to grapple, but I do think that, they're going to let it run hot. They've already said, we're going to do quote unquote inflation targeting averaging. And so they're going to let inflation run hot, is my opinion. And so it's going to be a very interesting dynamic.
Does the Canadian economy look like it's running on debt?
Yeah, well, I mean, for sure it's running on debt. It's a debt-fueled, it's a credit-based financial system, and we're basically just running off of, ramping up credit, and the real productivity of the economy is failing to sort of keep up with that. I mean, a lot of that, new credit is going into being lent against residential real estate. So, certainly is a drag on real productivity. But at the end of the day, this is the mechanism that the policymakers have used to propel us out of this recovery is to let's, boost let's boost the real estate market. Let's derive growth from by spurring a housing boom, and hopefully, that has ripple effects of, hey, higher house prices, okay, tap the home equity line, go buy a new car, leverage that, and maybe, when the economy reopens, you got a little bit more money for vacation, et cetera, et cetera. So you can clearly see, if you look at residential mortgage credit growth, it's running at a decade high, and I think that, by the banks essentially pumping out credit, which is what they're doing, is they are stoking a housing boom, and I think that's all part of the policymakers' plans.
Are lenders likely to make it tougher to get credit?
I don't see that. I think we're doing the exact opposite right now. I think, again, you have to kind of watch what banks are doing, and the banks are extending credit because I think that they've been directed to extend credit to keep us out of a recession or try to get us out of this. And the policy goals, again, have been to extend credit into the residential real estate space, which is where the majority of your credit is being created today. And that is obviously, again, stoked the housing boom. And I think through that boom, they're hoping that has trickle-down effects. Has the COVID year been good for the real estate industry? Well, yeah, for sure. I mean, I think it's been, probably one of the biggest benefactors. I don't think there's anybody that needs convincing of that. I mean, you had 2020 in Canada was marked by all-time record high in national home sales. So it was probably the best year ever for real estate professionals, people in the real estate industry. And that's, considerably surprising given sort of what was happening in the real economy. What are foreign owners of real estate doing? I really don't have too much to comment on that, to be honest. I mean, it's pretty quiet on the front. I mean, it's certainly not really one of my go-to clientele, so I can't say that have some sort of insider information. I mean, from what I understand, talking with other people in the industry and looking around, it's the majority of what's happening in today's housing market is being derived by local end users, families that are already here participating in the housing market, most of them looking for more space. That seems to be where all the activity is coming from. Again, there's not really any international travel at this point, so it's a much different dynamic than we saw in 2015, 2016. Could this spring market be one for the record books? Yeah, I think we probably will. I think we'll probably see, if not record sales, very, very close to it. I think you'll obviously see record prices on a national level, probably on a Vancouver level here as well. All the signs are pointing towards that. And again, I think that we have pretty easy comps here from March, April, May. If you're looking at it from a year-over-year perspective, you're going to be looking at extremely easy comps to beat. So we had a housing market that was basically shut down in April and May of last year. So those are going to be very easy. You could see insane year-over-year increases, which, could ultimately stoke more media headlines, more speculative fever, more fear of missing out. And then I think as you get into the summer months, particularly, July and August, those are going to be very difficult comps to beat. I don't think we'll beat them. And I think, if anything, that's potentially maybe where you can start to see, a bit of a pullback in the housing market potentially. It's very hard to say, obviously, but I think the biggest thing right now is just watching what's happening in the bond market and where yields are going and where they'll be over the next several months. If someone wants to invest in real estate, is now a good time? Well, we're seeing a lot of investors jumping back in now. I think that, again, you look at household savings rates up around 25-30%, and people are looking around and saying, hold on a minute, the Vancouver detached and townhouse markets are up 20%, basically, over the last 12 months. The condo market is up maybe 2 or 3%. Is that going to start to play catch up? And so we're seeing a lot of the investors jumping back into the market, even though the rental market's still a little bit soft. Investors are looking around and saying, well, hold on a minute. We're going to be reopening soon. We're ramping up immigration again, and hopefully we're going to have some international travel again somewhat soon. And so this is the mentality of the investors. And so we're getting a ton of investor calls right now of people And we're seeing now, one-bedroom condos in downtown Vancouver. These are all going multiple offers again when, 6 months ago it was a pretty tough sell. So, significant change there, and it'll be interesting to see how things play out.
Stock markets have made some people a lot of money in the past year. Is this money moving into real estate?
I don't know if I'd say it's moving into real estate, but I think it's all relative, right? It's people that are buying real estate oftentimes have part of their down payment in the stock market. And so if the stock market drops 20%, suddenly people's down payments have been impacted. So, when you see a rising stock market like you have, a rising tide lifts all boats. And so these financial markets are all interconnected because they've become such large components of our lives, because the global economy has become so financialized, is that all these asset classes pretty much move together. And so, if you have rising yields, the stock market sells off, and probably in due course you'll see a pullback in the real estate market as well, assuming that yields go up and stay up for, a little bit of time. You have to understand that the real estate market is not a real-time, day-to-day fluctuations like you do have in the stock market. So, but they're all interconnected. So I think that's really the most, particular thing that I can kind of highlight.
Some people comment on record high mortgage debt, but at least one person I know who's an expert in the real estate industry says people should really look at their mortgage as an enforced savings plan, because that once you have your mortgage paid off, you can use the equity in your home to leverage all kinds of financial deals.
Well, yeah, obviously I think there's different trains of thoughts in that, and I think everybody obviously likes to focus on the debt picture. I think it is a debt picture that is very, very alarming in Canada. I think that at some point, I don't know when, maybe it's a year, maybe it's 10 years, you're going to have some sort of debt crisis in the private sector. But don't get me wrong, it has been a tremendous wealth builder. I think it's proven it's, not just in Canada, but over time, obviously there's a lot of wealthy individuals that own real estate for a reason, particularly because you're borrowing credit over a long duration of period over a fixed asset. So, real estate has always been a strong wealth builder. It doesn't mean there's not risks involved. It's understanding those risks. But yeah, certainly it can be looked at as a savings vehicle, and ultimately, the more credit you build, the more credit worthy you are with the bank, the more you're able to borrow, the more you're able to take advantage of low interest rates. And this is kind of, again, getting back to the wealth inequality of things, right? So you have people that, okay, well, I've owned this home for 10 years. Let's say I've owned this condo for 10 years. What you're seeing a lot of now is, as opposed to simply selling that condo and upsizing to a single-family house, what you're seeing is people leveraging the equity they've built in that condo over the last 10 years, keeping the condo as an investment property, leveraging it, borrowing the equity that's built up into it, and then using that towards part of your down payment on your house. And so people that have equity in the markets are able to leverage that and accumulate that. And again, that's all part of this low credit environment that we have. It's great for people that have assets and net worth and credibility with the bank, but makes it increasingly more difficult for those that are trying to get in onto that housing ladder.
We hear complaints that the government is doing little to make housing more affordable. What can they do?
Well, I don't think they can do a whole lot. I think that the only way, yes, you can continue to try to build more housing, which they certainly can and need to and should be doing. But I think the reality is, it's like, how do you really get more affordable housing? Outside of a correction, it's going to be very difficult to do from these levels. So does the government want to let housing correct? Well, when it becomes almost 25% of your GDP, probably not. And so, I think at this point, a lot of these policies that they're introducing and probably going to continue to introduce are more just, it's just lipstick on a pig. You're just trying to, pander to the politics of it, to look good and make it look like you're doing something. But I think it's very difficult to get affordability without, some sort of meaningful correction in prices, whether that's 15-20% pullback. How do you get increasing affordability? You can continue to ramp up housing supply, But, is that, I don't know, I have struggled to think how much more affordable it's going to make it. Maybe it makes it 5% more affordable. I don't know.
A lot of developers complain that it takes them years to get the building permits and zoning permission and so on to build new homes. Is that a problem, the extensive red tape you face at City Hall?
Yeah, I think so. I think Vancouver is one of those ones, right? I mean, gosh, you look at, places like, I can just give you an example. I'm looking at building a property in Calgary. It takes 2 months for permits. In Vancouver, you're looking at, a minimum 6 or 7 months, for the same process. I mean, for a developer to come in here and build, a high-rise condo, I mean, you're looking at start to finish. I mean, that's a 7-year project. First 3 or 4 of it just trying to get through City Hall. So, there's an incredible amount of bureaucracy, that it does ultimately hinder housing supply. Obviously the taxes and fees that go along with that housing supply certainly attribute to the, affordability issues as well. So I think governments are kind of their own, worst enemy in terms of housing affordability.
Do you cringe when it seems to me every time a politician has a suggestion about housing, it involves more taxation of somebody somewhere?
Right. Yeah. I mean, what's that old saying? It's like, hey, I'm from the government. I'm here to help. It's the scariest words you can hear. So, yeah, I mean, I suspect a lot of them are coming from, well-intentioned ideas and policies, but I think a lot of these are ending up, going to backfire, and they kind of have.
Well, I remember the late great Diefenbaker, former Canadian Prime Minister, said government is doing skillful surgery with blunt instruments.
Yeah, it's been tough to crack the affordability issues in Canada, and I think that again, a lot of it comes down to every time you look like you're going to get a correction in the housing market, everybody kind of rushes in to prevent that, and obviously, when you intervene into these free markets, so to speak, you create repercussions, and I think one of these repercussions, for example, I think the biggest thing to kind of people should take away from this is that, coming into this pandemic, we had basically a 20-year bull market in housing, right? So everybody was looking around saying, well, housing's pretty much, you can't lose it in real estate in Canada. Look at the last 20 years. Everybody has sort of that recency bias of, wow, like even during the financial crisis, we had a 6-month pullback and it was back up to new highs within the year. So everybody thinks it's invincible, and then the pandemic comes along and everybody says, okay, this is it. CMHC comes out and says you're going to see a double-digit price decline. And so what do policymakers do? They pump, right or wrong, they pump a whole bunch of money into the system. They help the banks out by lowering stability buffers. Let's just get credit out the door. So let's pump credit into the real estate market. Lo and behold, 12 months later, house prices are up double digits in the midst of a pandemic. And so what does this do? People look at it and say, wow, even during this pandemic, the largest labor shock, unemployment shock in 50 years, and real estate still went up. So people are just being reinforced and re-ingrained that real estate can never go down, and it just creates more of this speculative behavior, this more of, well, I'm just going to keep plowing money into here because the government has my back. They'll never let this thing correct. And so these are some of the, adverse side effects or repercussions of these policies, is that sure, you might have staved off a correction and a little bit of pain, but you're creating more bad behavior.
Steve, what's the best way for people to get in touch with you?
Probably by email, steve@stevesaretsky.com. And again, pretty active on Twitter at Steve Saretsky, if you kind of want to join the conversation.
Steve, thank you so much for being on This Week in Money.
My pleasure. Thanks a lot, Jim.
My guest has been Steve Saretsky. He's a Vancouver-based realtor. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Dr. Marc Faber, and Steve Saretsky. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@howstreet.com. Now stand by for a company showcase update from American Manganese CEO Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to Company Showcase, Larry.
Thanks, Jim.
Larry, what's the big news coming up for American Manganese?
Well, we had a news release this week, and it's to do more with the presentation that Zarco is going to be doing at the International Battery Seminar. And, the good part about that is we'll be talking to a lot of people that would be interested in our process. But looking at the market today, even after the NASDAQ went up and everything else went up, we continued to go down. Or we went up, but we turned around and went back down, thanks to the predators out there that really are frantic to protect their short positions at much lower prices as far as I can see. But that doesn't matter because we haven't taken a step back. We didn't announce that we got bumped from the program. We announced that we'd be doing it. And but these guys, every time we put out a press release, they make sure that the stock goes down at the end of the day. And I just want people to realize that I'm not whining or complaining. I mean, I don't like to see investors losing money. I don't like to see investors losing value, and I don't like to see myself losing value. So I've been talking about these predators for 8 years. Nothing has changed. Doesn't matter where you're located, where you're listed, or anything else. It seems like the Canadian market prevails with no short rule. And these guys are eating everybody's lunch here. So that's enough of that rant. We got a lot of good things happening. We've had a lot of good calls this week, and I see some dynamics changing, and I want people to realize this is not the same company it was 6 months or a year ago. It's a well-advanced company with solid patents in the U.S., and, we're one of the few companies out there that is transparent about everything that we do. So, this is a quandary to me, how these guys can rule the day, but that won't last forever. That will end, and they have no idea what we're working on or anything else, and I don't put that out there. I get all kinds of emails of when you're going to start production, when you're going to do this. I would not put that out there because that would just spur these guys to further predatory trading, and, I'm here as the watchdog for our investors. I try to be. I was a hero last week. I'm an asshole this week, but that's the name of the game. And, we just got to keep continuing on, doing the work that we do, and making sure that when we finally get the product out there, that it's first class and we'll be first in line. People don't realize that anything that's half-assed out there will not be able to get permits a year from now or whatever because the countries themselves will impose strict requirements on recycling. And so that's part of our plan, is to make sure that our recycling is green and it is a closed circuit and it's not putting anything back into the environment. We're trying to do the latest thing that's for a battery manufacturer, and so we just go on from there, Jim. It's all we can do is the best we can do, and we have a pretty good network of investors. But these guys, when you don't have to own the stock and you don't have to borrow it, they can, we're at their mercy. But that won't last forever because hopefully there's going to be a shock one of these days. And I'm not going to say what that shock could be, because, it's still a question mark with me. But I do know from looking after markets for 40 years, when you're doing the right things and sticking with your plans, that eventually that shock will come into the market, and we'll forget the bad days. So, I'm excited. We've had a couple of calls today. I'm not excited about the market. That's a downer, but I am excited about the prospects of the company. And the company is well financed to do the next what we have to do over the next 2 years. So we're not like we're going to go back to the market for any money immediately. And so we're in good shape. We're in good shape for this attack, and we'll come out of it.
Larry, what's the latest on the pilot plant?
Well, the pilot plant, we're still doing testing for the morphology of the particle sizes and everything like that. That's a new piece of equipment which may change the overall cost of the plant, but it'll give us a product that actually battery cathode manufacturers can utilize immediately, because that's exactly what we want to prove out there, is that we can do that. And so that's looking good, Jim.
Do you envision your recycling plants to be near battery factories, or would it do the recycling locally?
Well, it's, let's be honest, if you read the press releases and what we hope to accomplish with the morphology, we could be actually a supplier to the battery manufacturers, and we could skip a whole step. Recycling and is one part of it, the biggest part of it, and then but with the morphology and everything else that we need that's required by tier 1 companies or battery manufacturers for that part, that puts us into a totally different state.
Larry, could your company make Canada a leader in EV battery technology?
Well, we're looking into that right now. Certainly, I believe that we are a leader and have been for 2 or 3 years, and we don't have what we call proprietary methods of getting the cathodes out of the batteries, but we have patented methods of getting those cathodes out of the batteries. And so that should be a huge plus, and we're very transparent about it. If you wanted to follow the company and really go through it, you'd go to our website and see that, hey, this company seems to, have everything that's required out there. So, I'm thinking that, as a Canadian company, that we'll put them on the map for recycling and maybe for cathode processing.
Larry, for people new to American Manganese, what's the company all about?
We're a critical metals company that has a patent on low-grade manganese. We developed that at a large cost back 10, 12 years ago. We got the patent on that in 2012, and that's a cornerstone of our recycling. We got those patents through very jiffy quick. The second one was only 81 days, so that tells you there wasn't any competition in the area that we were in. And so it's, those are benchmarks that people don't remember. We're not talking about somebody cooking a cake in the kitchen. We're talking about R&D, the most intense R&D that I've ever done in my life, and Chemetco's doing the R&D, and they're totally qualified to do that. So, there wasn't any sense in me hiring a couple of metallurgists and trying to develop our own R&D. So, that's what the company's all about, and we have a website out there, AmericanManganeseInc.com, where you can do your due diligence. If you're a deep diver and you want to make a big investment, I would advise that you go and do that. And trade the company on the venture exchange under the symbol AMY, the U.S. under OTCQB, and that, allows actual investors to, it should attract a lot more investors, but ever since we announced that, the shares have gone down, but that's typical. And the truth of the matter is that that's going to be a world beater. That'll be something that we can set up to maybe move to the NASDAQ board at some point. So, it's that part is really good. You can, and our symbol is the same, AMYZF for the QB board, and the symbol for Frankfurt is 2AM. Now, you can contact the company at 778-574-4444. You can email me at LREAUGH@AMYMN.com.
Larry, thank you so much for the update.
You're welcome, Jim.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on March 5th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.